about another area. You're talking about debt, but interest rates in general. We saw the first Fed rate cut in years. What has the market done since then?
It's ironic that you mentioned that as well because it also relates back to the election. If you listen to some of the election, the campaigns are like, and interest rates are going down. On the contrary, interest rates, specifically the 5-year, the 10-year, the 30-year, have actually soared higher since the Fed has cut. I'll give you specifics in here. So if we were to look at the 10-year, that's the 10-year, obviously Treasury, and the interest rate associated with it. A few weeks back, right when the Fed was cutting by 50 basis points, right? The interest rate was actually in the 10-year was sitting right around 3.6%. Today, it's actually over 4.1%. So most of your mortgages, even though you have a 30-year mortgage, even a 15-year mortgage, those are actually based off the 10-year, and the rates are actually soaring on them, uncomfortably so, the speed to which it's going up. And, we haven't seen too dramatic of an impact to home builders yet, but that's actually a trade opportunity that could be there where, the home builders could start to actually come down. But so you've got asset classes that don't typically trade in these correlations. We're all over the place right now. Gold's up, the dollar's up, interest rates are up, S&Ps are almost at all-time highs, an election's coming up. It's not the most comfortable marketplace. It's probably one of the reasons volatility has been higher. It's not one of the more comfortable marketplaces that I've been in the last, 25 plus years.
All of the things you just mentioned are why a lot of investors are looking for some guidance. How do you manage your own portfolios, your own investments in the middle of this uncertainty?
So in two very definitive sides of me. So I have an investment side, and then I've got a little bit more of the trader side. The trader in me, if I'm going to get bullish or bearish, I'm going to use spreads. I'm going to use spreads because I want to mitigate the total exposure. A spread basically says like, look, if I go out and take a trade inside of Apple, I know exactly what my risk is going to be. It's $1.50 getting in here, or it's $1 getting in there. I know exactly what that's going to be. So I'm going to take measured, just pokes at the marketplace, looking for specific upside opportunities and or downside opportunities. Now that would be the trader in me. The investor. Look, investment right now with S&Ps at all-time highs makes me nervous, but the S&Ps have been continuously hitting all-time highs. I am really, avidly into what we term long short. There are areas that, for instance, I own, a few of the tech companies right now, but I'm also heavily short, for example, the financials. There's nothing wrong with creating short positions. When I say short, that means in the financials, I use the XLF, and I may actually substantiate a position, where I'm actually short shares, or, using a deep in the money option to simulate a short share. It's what we call a synthetic. That would be for somebody like that traded inside of an IRA. But in no uncertain terms, like I'm just not comfortable in these markets, just saying like, okay, I'm going to buy the S&P 500 and buy and pray is not going to be a good strategy for the foreseeable future. And we've actually heard some of the largest banking institutions in the world just in the last 24 hours talk specifically about that future returns for like the next decade are going to be largely mitigated due to higher volatility, higher interest rates, debt issues. This is going to be a challenging time. This is going to be a time where you're going to have to learn more than just throw money at the market and pray. That's unfortunate, but that's what firms like TheoTrade do is we educate specifically around those logics.